Welcome, guys. Welcome. It is what we all been waiting for. FOMC rate decision day. About to go down. It's 1:59 right now. Got my boy Kevin live. About to pull up the news. Let's get it, guys.
Intelligence that we plan to license out at the beginning of next year, which could be a revenue game changer for Househack and a valuation game changer, obviously. We still expect to release our beta here.
Got the NQ on the boards right now. Currently, my famous white box is a previous day range, Tuesday range. We're already trading outside of it on the NQ to the downside. Bounced off of last week's high. 2 o'clock right now. Little pump going on. Go back to Kevin. Let's see what's going.
Oh, and it always comes through so freaking fast. I can't read it this fast. It says Federal Reserve cuts 25 basis points, additional 50 basis points by the end of the year, and another 25 in each of the next 2 years. So they're not giving us a lot of forecasts, but an additional 50 by the end of the year. Dude, that's 3 cuts this year. That's more bullish. That's more bullish on rates coming down than expected. Okay, so markets were pricing in by the end of the year 2.2. So I gotta write that down. 2 before this changes. 2.25 is what markets were pricing in. We just got 3. That's huge. Job gains have slowed. Unemployment has edged up but remains low. New Governor Moran dissented on policy favoring 50 basis point cut. Of course, there's your Trump shill. No duh. Inflation has moved up, remains somewhat elevated. Growth has moderated over the first half. It's moved up and remains...
All right, guys. So news came in. 25 basis point cut, like we expected, but Powell did say an additional 50 basis point cut by the end of the year. To me, that is bullish. Charts are reacting. I mean, NASDAQ is pretty much in the same spot that it was. Pretty much pumped off that last week high, right under Tuesday low. Did kind of pump right into Tuesday low. It's the 4-hour chart right here, so go down to a little smaller time frame. You can see the immediate reaction, but yeah, a little bit of a bullish curl. A little bit of a bullish curl, and NQ still under that Tuesday low. YM pumped nicely. Still over previous. Yeah, still over previous day high, so still bullish on that. MES. All right. MES back in the previous day range and in the middle of the range by the 50% line. So yeah, 25 basis point cut as we expected, and we're looking at an additional 50 point cut. Let me get Kevin and get some more news in, but that's what the statement is looking like. Let's go
for this. Now let's get the actual SEP. But this is very bullish. I mean, goodness gracious. This is great. This is
very bullish. That's what we like to hear.
Expecting that. That's great. This is it then makes you wonder, like, what do they know? You know, that's where you start scratching your head. You're like, wait, what is the Fed seeing? So let's actually get the SEP for September 2025 up here. Looking at the reaction, obviously, people are pretty excited about this, as we should be. Here's the summary of economic projections. Let's go to the dots because it's a quick, easy visual. No, there's really... Like, if I compare the dot, I don't care that much about the dots. It looks like everybody moved under 3 for next. No, you've got 5 under 3 for next year, 2 under 3 over here. So you definitely had a meaningful shift down. Everybody is under 4. Well, you only had 1 above 4 over here. And then you have very few above 3.5. Whereas you had more concentration above 3.5 here. Okay, September SEP, here we go. So this is where we got that revision up to 1.6. This is surprising to me that they kept that unemployment rate stable. So Fed, IMO, this is dovish. This is dovish. This is bullish. Rates down. This is bullish. QQQ 600, right? Like, this is good. Then you've got, let's see here, unemployment rate staying at 4.5 is a very, very strong signal from the Fed. Basically, what they're telling you is, hey guys, look, we are going to cut 3 times this year. And as a result of us giving you this extra rate cut, you better not drop the you better not screw up our unemployment rate. You see that right here? Fed funds rate, the June projection was 3.9. This is critical. That's an extra rate cut right there. So this is 3 cuts. 3 cuts, very, very bullish. Again, markets had this at 2.25. So that extra is what we're throwing in, right? So let's see here. Then you've got 25 and 25. Let's see here. You've got 25 here for next year, 25 here. Obviously, that's 5 cuts by the end of 2027. 5 cuts by end of 2027. Markets were pricing in. Oh, that'll just take me a second to see. So markets priced in end of 27 before the decision. Here it is. 5. 4. Yeah. Markets priced in 5. So that aligned. That aligned with market expectations. So the big change is just that we're front loading a bit. So basically, Fed is front loading rate cuts here, hoping to keep unemployment stable. But that's a double-edged sword, right? So I look at that as a twofolded. One, it's exactly what the Fed should do, right? This is exactly what the Fed should do. However, the reason I say it's a double-edged sword is because it means the Fed is actually realizing they have to get off their ass. Otherwise, Donald Trump is going to be right and Powell's going to be too late, right? So that's a serious, change here. Now, let me see if Moran sandbagged any of these numbers. So I'm assuming that the highest numbers are Moran. I actually do not see any sandbag. I am shocked. All of the Fed members are convinced that with this action, they can save the labor market. With inflation, they all basically see us at mid-2s. They're going to keep mid-2s. They're going to wash that away with flexible inflation targeting to wash away mid-2s. And no Moran sandbag other than dissent for 50, right? So whatever, that's actually more respectful than I thought he was going to be. I thought he was going to come in here and just absolutely destroy the summary of economic projections and just like tear it up basically. He didn't do that. So this is very interesting. So I
All right, guys. So the initial reaction, as you can see, pretty much a bullish reaction on the equities right now. Kind of slightly pulling back from the highs. CES is the UNCH product for the day, so just trading in the middle of Tuesday's range. NQ has backed away from Tuesday low. It's still trading outside the range. The knee-jerk reaction might have been bullish. We are pulling back a little bit, but I think everybody's just digesting the news. We got Powell coming out to make some statements at 2:30.
2:30.
YM is blasting off. What's the all-time high on YM? Goodness gracious.
So we got traders to add to bets on at least one more Fed rate cut. And like they're saying, it's going to be at least 50 more basis points by the end of the year.
So one more cut and it's probably going to be at 50 because we already planned to cut in January.
Yeah, so we're waiting on further news. We got the FOMC press conference with Powell is going to be at 2:30. So
2:30.
Stationary till then, and then
Okay.
right after that, literally right after Powell gets off, we're going to get on
Yeah, and we got Trump at 3 on Fox. So see what happens, man. Everything's
but the
still.
market's pretty much still in the same place it was.
Yeah, nothing really happened. You feel me?
Yeah, which is fine. I mean, they priced in 25,
Yeah.
so at least it wasn't a sell the news kind of thing. YM is definitely.
If YM is preempting the move, that's gone right now. Yeah, it's gone right now. YM is doing the best, but tech may lag on this move. I mean, it normally does on the rate decision moves, correct?
Yeah.
You see lag.
Just because the banks are going to benefit from it immediately. It's like the,
Yeah, this is what I want to see.
People borrow money for cheaper, they're taking it to tech. So they know that's the delayed.
Yeah, that's the late reaction. All right, yeah, everything's pretty much in the same spot. That's kind of.
NQ is pulling back more, man.
It's pulling back,
Hasn't
but-
broken low enough.
Yeah, it's not nothing hasn't done already today. Reject Tuesday low. Yeah, fucking excuse me. YM pretty much made a new all-time high. YM all-time high was at 46,580 area, 46,589 areas.
Yeah.
Anybody?
1%.
Yeah. Anybody made the bullish move? What's the YM? Definitely tapped.
The ladder is lagging. They're going the NQ and the YM are grabbing in 2 separate directions.
Yeah, YM made a new all-time high, while the NQ is not doing anything.
Back at last week's high, probably got to put in a new low on a couple points. These are the instruments you want to watch for sure. YM and NQ for sure.
All right, we're here, guys. It's gonna,
Drastic.
nothing crazy. Gonna be here.
I won't be here. Just catch Kevin Russell going through the documents.
All right, cool. About to post up. Let Kevin break down the docs, and we got Powell coming out, showing his face at 2:30. So, as of right now, not a drastic move. No new lows made, new highs made on the YM, and ES is pretty much in the middle of yesterday's range. So, everything's chill. We'll continue to see what happens.
Curve will skyrocket to 5% rapidly. Okay? Then, in that case, in either of those scenarios, every Fed member will be wrong, which means their front loading of 3 cuts in 2025 did not work or was too late. Now, keep this in mind. This is critical. Markets today, markets priced in, let's write this down. Markets priced in, what do we have? I wrote this down 1 sec.
Coupon linked below.
Markets priced in 2.5 cuts by December, and we got 3 forecast by Fed. However, markets priced in 5 cuts by end of 2027. We got 5 cuts priced by or forecast by Fed, right? So really, this is a front loading. This is a front loading to get ahead of 1 and 2 above. 1 and 2 above, these are your red flags. I'm going to put the little warning emoji here because it's really, really critical. Hit that submit button. There we go. We're going to make Fed bingo here in just a moment, but that's a critical number. So we're going to watch that. Mind you, if you don't have this yet, like if you don't have time to watch all the videos every day, not everything makes it onto here. You get so much great perspective, I believe, in the videos. But I know sometimes y'all get busy and you're like, man, I just need a quick catch up with some of Kevin's data. Realize you could get it totally for free. And yes, you could change the colors. You could get it totally for free right here. This is the Meet Kevin app, and you just go to the data tab. You can also adjust your notifications like, hey, Kevin, I don't want all of your posts on like pilots or life or housing. I don't care. I just want your Fed videos. Then just change the notifications to just Fed videos. And then you could see this data in the Meet Kevin app. It's really convenient. Again, you can change the color theme if you don't like the green. I like the green, okay? Damn it. I chose the green, so I'm a little partial to it. If you go to meetkevin.com for the Meet Kevin membership, it's all green. If you go to househack.com, it's all green. I actually have to say, though, I mean, unlike this banner right here, which I threw together in like 10 seconds, so, forgive me, I know it's crappy. I have to say, I kind of like the design that we have at Meet Kevin for like the Meet Kevin membership. I like this. I think we did a good job with like the gradients and, what everything you get with the membership, lifetime access, tax deductible. I mean, all that stuff. Okay, so let's now make Fed bingo and let's see what else is going on here. We've also got, let me look at what the suits are saying. In their outlook, okay, suits are now saying, following what was observed on the labor market, it's interesting they scraped the word solid, but at the same time, the new median forecast actually represents a slightly tighter labor market. So Fed removed word solid from labor market. That's interesting. Okay, then we've got... let's see here. Okay. The skew of the dot plot remains slow. Okay, median, but the median 20 moved it all, but there are 5 members who see rates below 29.3%. That's fine. Okay. We've got 3 cuts here. That's good. And let's see what else we have. So Fed, I'm just going through to look at Fed statement changes here. Looking again, we've got Fed reduces overnight rates to 4 to 4.25. To get to 4.6, we would need 2 cuts. I'm just fact checking myself. We need that. In order to get that, you need the 2 extra cuts, because then you would go to 3.75 to 4, and then you would go to 3.5 to 3.75. Which would median out to 3.6, which is exactly what we have here, 3.6. So that's 3 cuts in 2025. Okay, then I've got, okay, so that's that. Let me see what else the suits are saying here. The tone, oh, this is interesting. The tone overall favors growth concerns as the Fed is showing rates still, despite inflation above 2%. The lack of more dissent shows unity around the pathway to neutral. Yes. That is also very interesting. I'm going to write that down. The Fed is very unified here in 3 cuts this year. Only Milan dissenting for 50 now. Again, I think more cuts now is what we need. And I'm just worried about the Fed being, well, frankly, I mean, I hate to use the word, but too late. Whoops. Too many of those emojis. Okay, so let's see. Fed presser is in 14 minutes. Okay, we've got, following the language of the labor market, they scrapped the word solid. So the word solid was removed. I think this begets them seeing some underlying concern. The Fed is seeing something. So let's see here. Then I've got, in their outlook, the Fed policy slightly upgrade. I see. So my like bear take here is this is not enough to keep unemployment stable. If the Fed thinks an extra cut or 3 cuts this year is enough to keep unemployment exactly stable at 4.5, they're probably going to prove to be too late, that's the bear take, right? And it makes sense. Bear take. Okay. Okay, that's reasonable. Let's see what else we have here. We've got in their forecast, they upgraded their median outlook. That's fine. I've got Waller could argue. Let's see. Today's interest rate cut. Let's see. We got 3.6 for the end of the year. Okay, that's fine. Dot plot. 10-year falls under 4. Good. Modest upgrade to Fed's growth outlook next year, but they also expect inflation to be a touch higher. Let's look at that. So GDP for next year, they did bump us to 1.8, which is fine. The soft, remember what a soft landing is, right? So this is critical. Remember what a soft landing is. A soft landing is below trend GDP growth And 1995, yield curve gets to about '06, uninverted, and then normalizes back down. And it really just signals more of a signals maybe a potential post-COVID, post-AI boom slowdown, but not recession. That's a soft landing. Whether we get that is entirely dependent on labor. This soft landing, let's say that, the soft landing is entirely dependent on 1 and 2 not happening. Okay, so remember, 1 and 2, these are your caution emojis here. These are critical. This is what you pay attention to right here, folks. 1 and 2. If labor force participation increases, and the unemployment rate will skyrocket, all the Fed members will be wrong. And if layoffs increase, all the Fed members will be wrong. That's a big deal. Okay, so now we're going to jump to making our bingo board. Again, all of this that I wrote out is already in the Meet Kevin app. So if you're on Android, go to meetkevin.com/gapp. If you're on Apple, go to meetkevin.com/app. It'll link you right to it. Leave us a 5-star review. And I honestly think it's a great app. It does what it says it's going to do. So, all right. Now, we need to make we're going to make our, bingo board. And we're going to evaluate, wow, look at that. The Q's now at negative 69 basis points. Gave up a little bit there. That's interesting. Waiting for Powie Wowie, huh? All right, let's see what happens. So we've got Tesla. Hey, Tesla, though, look at that. Look at that 414 test right to the line. This is the stuff you get in the alpha reports. All right, let's go. So, bingo board, Fed bingo, my friends. I love Fed bingo. If you want, go ahead and start giving me some bingo topics. What are we expecting Powie Wowie to say here? Obviously, I'm going to give you my take as well, because that's what I do. And I actually, we finally made a bingo board. I know some of you have seen it all in the last few times here. I just have to get it from my favorites. There it is. But I'm so grateful to have a bingo board because making it, I sucked at making the bingo board. There were so many times where it's like, oh man, Kevin, you don't count enough rows. Where's my pencil? My stupid iPad pencil though. All right, whatever. No problem. The show will go on. All right, so let's go and cook up the bingo board. All right, my friends. So first thing we're going to get is we're going to go on time. Okay, this is obvious. He's always on time. Then we're going to give ourselves, we'll give ourselves a second freebie here. We'll go purple tie, right? Purple tie, purple tie. Okay, then we're going to get balance of risks. Oops. There we go. Balance of risks. Okay, this is basically a way of saying, hey guys, I'm really nervous about the labor market. You got to pay specific attention to everything he says about that labor market. But then, of course, we're also going to get the famous one. We've heard this one from everyone.
Data dependent.
Even the Halo guy says it. Who would have thought the Halo guy would say it?
Data dependent.
All right. Then we've got, okay, so, this is where it's going to be interesting to me. I think that Powell is going to tell us about this potential normalization of the labor force participation rate. If he does, it's good because it means he's aware that it could change very, very quickly, and that would be bad for the Fed. So participation normalizing, we're going to write that down. So participation normalizing would be bad equals bad. Okay. Not only participation normalizing equals bad, but then we're also going to have the, you know what I really should do is, let me just throw this on the computer because I think my handwriting is just going to kill everybody here. So I'll just slap this on the computer really quickly. And I think what he will say, like, he won't say, oh, it's, you know, we're worried about layoffs taking off. He's not going to say that they're worried about the labor market taking off. Instead, it's much more likely that he's just going to say something like, if layoffs were to increase, we would be prepared to move faster. So that would be an assumption there. We'll see if he ends up saying something like that. Then I think I think they need to come across as really believing that the labor market isn't going to roll over. They have to sell us on that idea. Sell us that you're right, that your rate cuts are actually going to be supportive of the labor market. I don't know if markets will buy it, but that's what they're going to try to do. So he's going to have to sell us that these adjustments to rates should support labor. Okay? He'll say that. I don't know that it's going to be enough. So we're going to get the word, you know, rates are normalizing. Rates normalizing to neutral. And I think then we'll also get some talk about the like not point transitory inflation, but over time transitory, right? So not point transitory inflation. Instead, it's going to be over time. So over time, back to 2%. And he won't say transitory to 2%. He'll just say we'll get back to 2% over time. That's going to be sort of his way of selling transitory. Let's see here. Then let's see here. Yeah, no, Kevin doesn't need to acknowledge, or Kevin needs to acknowledge the government layoffs are coming next month. Do you not watch the frickin' channel where we talk about this stuff every day? We know the government layoffs are coming. Come on, folks, that's already priced in. You get the labor report next month and people are like, oh my gosh, job layoffs because of those. People are just going to look at it and go, yeah, we know, but that's a one-time layoff. Like, come on, man. Like, that's already known. You know, you get these bots sometimes in the comments that are like, oh, you know, Kevin's purposely not talking about this. It's like, bro, wake up. It's because we're so far beyond. We're 11 miles into the marathon, and you're still, you know, half a mile in, trying to figure out where your water bottle is. Because you're a little weenie because it's warm outside. Come on, small peepee.
Little PP.
Kevin is very talented, but I don't know if it's going to be him, but he's a very talented guy.
Kevin is much more interested than most people, by the way, in the balance sheet.
All right. Now we also need to recognize we're going to blow off. We will blow off. Powell will blow off balance sheet talk. Balance sheet talk. I think he'll have. I think he's gonna have a laptop today. I'm gonna go with laptop, and I'm gonna go with
Alright, guys. Got Kevin about to pull up Jay Powell in about 2 minutes. As you can see, the market already recovered that sell candle. ES is green, YM is green, NASDAQ is the only thing that's red by about 0.3%. So we'll see. Looking at the tech stocks right now, look like tech is recovering. Everything's red though, not a green stock on the tech board right now. Look like Tesla might be the first one to cross back over. This right here though, it's like the dips are happening so much faster. It's like, bro, if that's the dip and the NASDAQ ends up back at the 24,650 area today, that's gonna be insane. We'll be right back at all-time highs. The contracts too are still so far apart. I guess that don't really matter.
How far ahead?
Shit. Excuse me. Oh, still about those same 50 points. So it's about a 50-point spread on the contracts to make you stand that way. All right, Fed's coming out, guys.
Still pretty big.
Fed's coming out. Trade safe, man. As you can see, my account's locked up. Feel me? Yeah. All right, we out.
Implemented overtime. All right. So let's get that banner out of the way. I think you all already know. Daddy's back is the coupon for the Meet Kevin membership. Remember, you get lifetime access to that membership. So like, you know, our scenarios that we come up with when events like this come out, or the fundamental analysis that we're doing on stocks, or the top 10 stocks to buy over the next 10 years. Remember, you get those, as well as the top 10 stocks not to buy. Laptop, let's go, baby! Let's go, laptop! Andy's on time!
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. While the unemployment rate remains low, it has edged up. Job gains have slowed, and downside risks to employment have risen. At the same time, inflation has risen recently and remains somewhat elevated. In support of our goals, and in light of the shift in the balance of risks, today the Federal Open Market Committee decided to lower our policy interest rate by 1/4 percentage point. We also decided to continue to reduce our securities holdings. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that growth of economic activity has moderated. GDP rose at a pace of around 1.5% in the first half of the year, down from 2.5% last year. The moderation in growth largely reflects a slowdown in consumer spending. In contrast, business investment in equipment and intangibles has picked up from last year's pace. Activity in the housing sector remains weak. In our summary of economic projections, the median participant projects GDP to rise 1.6% this year and 1.8% next year, a touch stronger than projected in June. In the labor market, the unemployment rate edged up to 4.3% in August, but remains little changed over the past year at a relatively low level. Payroll job gains have slowed significantly to a pace of just 29,000 per month over the past 3 months. A good part of the slowing likely reflects a decline in the growth of the labor force due to lower immigration and lower labor force participation. Even so, labor demand has softened, and the recent pace of job creation appears to be running below the break-even rate needed to hold the unemployment rate constant.
Bearish!
In addition, wage growth has continued to moderate while still outpacing inflation. Overall, the marked slowing in both the supply of and demand for workers is unusual. In this less dynamic and somewhat softer labor market, the downside risks to employment appear to have risen. In our SEP, the median projection for the unemployment rate is 4.5% at the end of this year and edges down thereafter. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.7% over the 12 months ending in August, and that, excluding the volatile food and energy categories, core PCE prices rose 2.9%. These readings are higher than earlier in the year as inflation for goods has picked up. In contrast, disinflation appears to be continuing for services. Near-term measures of inflation expectations have moved up on balance over the course of this year on news about tariffs, as reflected in both market and survey-based measures. Beyond the next year or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation is 3.0% this year and falls to 2.6% in 2026 and to 2.1% in 2027. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to lower the target range for the federal funds rate by a quarter percentage point to 4 to 4.25%, and to continue reducing the size of our balance sheet. Changes to government policies continue to evolve, and their effects on the economy remain uncertain. Higher tariffs have begun to push up prices in some categories of goods, but their overall effects on economic activity and inflation remain to be seen. A reasonable base case is that the effects on inflation will be relatively short-lived, a one-time shift in the price level. But it is also possible that the inflationary effects could instead be more persistent, and that is a risk to be assessed and managed. Our obligation is to ensure that a one-time increase in the price level does not become an ongoing inflation problem. In the near term, risks to inflation are tilted to the upside and risks to employment to the downside, a challenging situation. When our goals are in tension like this, our framework calls for us to balance both sides of our dual mandate. With downside risks to employment having increased, the balance of risks has shifted. Accordingly, we judged it appropriate at this meeting to take another step toward a more neutral policy stance. With today's decision, we remain well positioned to respond in a timely way to potential economic developments. We will continue to determine the appropriate stance of monetary policy based on the incoming data, the evolving outlook, and the balance of risks. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate, based on what each participant judges to be the most likely scenario for the economy. The median participant projects that the appropriate level of the federal funds rate will be 3.6% at the end of this year, 3.4% at the end of 2026, and 3.1% at the end of 2027. This path is 1/4 percentage point lower than projected in June. As is always the case, these individual forecasts are subject to uncertainty, and they're not a committee plan or decision. Policy is not on a preset course. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission, and we at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to our discussion.
Okay, he highlighted that extra cut because they realized those downside risks. Let's go see what the questions are now.
Chris Rugaber at Associated Press. As you know, Fed Governor
This
Stephen
is dovish so
Byron
far.
has continued, kept his position at the White House, even as he's joined the Fed board. This is the first time, I believe, the Fed's board has had someone with executive branch ties in decades. Does this compromise the Fed's independence from day-to-day politics? And relatedly, how can you
Absolutely
maintain
not.
the public's perception the Fed is politically
And no
independent with
comment.
this dynamic? Thank you.
So we did welcome a new committee member today, as we always do, and the committee remains united in pursuing our dual mandate goals. We're strongly committed to maintaining our independence, and beyond that, I really don't have anything to share.
Fair. Totally fair.
Oh, I'm sorry. Can you, you and other Fed officials have spoken extensively about the impact of tariffs on inflation, although perhaps with many companies appearing to eat the tariffs, tariffs may be impacting the labor market and other parts of the economy instead. Do you see that as a possible outcome here, that tariffs
I just sent out a buy alert to the Alpha Report members, by the way, if you're in the Meet Kevin membership.
in inflation?
It's certainly possible. We have begun to see goods prices showing through into higher inflation, and actually the increase in goods prices accounts for most of the increase in inflation, or perhaps all of the increase in inflation over the course of this year. Those are not very large effects at this point, and we do expect them to continue to build over the course of the rest of the year and into next year. And it's also possible that there may be effects on employment, but that I would say if you're looking at why employment is doing what it's doing, that's much more about the change in immigration. So the supply of workers has obviously come way down. There's very little growth, if any, in the supply of workers. And at the same time, demand for workers has also come down quite sharply, and to the point where we see what I've called a curious balance. It's, typically when we say things are in balance, that sounds good, but in this case, the balance is because both supply and demand have come down quite sharply. Now demand coming down a little more sharply because we now see the unemployment rate edging up.
Nick Timrose of the Wall Street Journal. Chair Powell, do economic conditions and the balance of risks no longer warrant a restrictive policy setting?
So I don't think we can say that. What we can say is this, that over the course of this year, we've kept our policy at a restrictive level, and people have different views, but a clearly restrictive level, I would say. So, and we were able to do that over the course of this year because the labor market was in very solid condition with strong job creation and all those things. I think if you go back to April and now look at the revised job creation numbers for May, June, July, and August, I can no longer say that. So what that means is that the risks were clearly tilted toward inflation. I would say they're moving toward equality. Maybe they're not quite out of equality. We don't need to know that. But we do know that they've moved meaningfully toward greater equality, the risks between the two goals, and that suggests that we should be moving in the direction of neutral, and that's what we did today.
Under what circumstances would a larger than 25 basis points rate cut be warranted, and how seriously was that option entertained at your meeting this week?
There wasn't widespread support at all for a 50 basis point cut today. I think we've done very large rate hikes and very large rate cuts in the last 5 years, and you tend to do those at a time when you feel that policy is out of place and needs to move quickly to a new place. That's not at all what I feel certainly now. I feel like our policy has been doing the right thing so far this year. I think we were right to wait and see how tariffs and inflation and the labor market evolved. I think we're now reacting to the much lower level of job creation and other evidence of softening in the labor market and saying, well, those risks are maybe not fully balanced, but moving in the direction of balance now. And so that warrants a change in policy.
Colby Smith for the New York Times. Should we be viewing today's cut as the committee taking out some insurance against the possibility that the labor market is at risk of weakening? Or is it the committee's view that the dynamics of a downturn are already in place? I guess I'm just trying to square the shift in the rate forecast in the SEP towards more cuts than just 3 months ago, with the fact that the forecast for unemployment didn't change.
Yeah, I think you could think of this in a way as a risk management cut, because if you look at the SEP, actually, the projections for growth this year and next actually ticked up just a little bit, and inflation and unemployment didn't really move much. So what's different now? What's different now is that you see a very different picture of the risks to the labor market. You've seen, we were looking at 150,000 jobs a month at the time of the last meeting, and now we see the revisions and we see the new numbers. And I don't want to put too much emphasis on payroll job creation, but it's just one of the things that suggests that the labor market is really cooling off, and that tells you that it's time to take that into account in our policy.
So just looking at the SEP once again, the median participant has inflation higher than previously expected by the end of next year, and the Fed not getting back to the 2% target until 2028. So I guess I'm just wondering how you characterize the risk to price pressures of...
Yields are going up because he's walking back the dovishness of 3 cuts. I'll explain that, but that's expected. He's going neutral here.
That we need to...
He doesn't want to cause persistent inflation.
Restoring 2% inflation on a sustained basis, and we will do that. at the same time, we've got to weigh the risks to the two goals. And I would say since April, to me, the risks of higher and more persistent inflation have probably become a little less. And that's partly because the labor market has softened, GDP growth has slowed. So I would just say that
What's in 26? What do you mean he's not going neutral?
than one might think. And in terms of the labor market, what we're seeing is unemployment is still low. It's still a relatively low rate, but we're seeing downside risks.
Michael McKee from Bloomberg Radio and Television.
And remember, I did send out a buy alert to those of you in the Meet Kevin membership. Just in case you haven't seen it yet, you should have gotten an alert on the Meet Kevin app. And where else we
The
got some?
employment area is related to immigration, which your rate cuts wouldn't address. How do you see that as more important than inflation, which has remained almost a full percentage point above your target?
Well, I was saying that what's happening in the labor market has more to do with immigration than it has to do with tariffs. That was the question I was answering. So I wouldn't say that all of what's happening in the labor market is due to tariffs. I mean, you clearly have a slowing in it due to immigration. You clearly have a slowing in demand, which is now perhaps more than that in supply, and we know that because the unemployment rate has ticked up. So, that's what I meant by that.
We can follow up. Every year since 2015, the SEP has forecast that you would hit your target 2 years later. And this year, this SEP says you're going to hit your target 2 years later. 2% does not seem to be in sight. Does that suggest that the 2% target is not really achievable? And does this present any credibility problems for you in telling people that that's what you're going to do if you can never reach it?
Well, I mean, you're right. It does say we're going to get to 2% inflation in 2028, at the end of 28. But that's literally how you put the projections together. You're writing down a rate path, which is designed to create, over the course of the SEP, time frame, 2% inflation and maximum employment too. So that's all that is. No one really knows where the economy will be in 3 years. But the nature of the exercise is to write down policy that you believe would return to the 2% goal over at least by the end of the exercise.
Thanks so much, Elizabeth Schulze with ABC News. The latest inflation report shows that prices are still going up across key categories for many households, including groceries. What will the Fed do if prices pick up more?
So our expectation, and you can see this consistently through the year, has been that inflation will move up this year, but that basically because of the effects on goods prices from tariffs, but that those will turn out to be a one-time price increase as opposed to creating an inflationary process. That's been our forecast. Pretty much all the individual forecasts say that. We can't just assume that, though, right? We have to. Our job is literally to make sure that.
As you can see, guys, NQ is biting the cheese right now, currently leading the market to the downside. Tech is getting wet. Guys. AMD down 3%. 2%. Nvidia down 3%. Google is down 1.3%. Everything that's been rallying, guys.
Dude, Ryan is doing diabolical work. It just wigged. Oh my god, all-time high all the way back on Monday.
Yeah, wow. Whoa, look at the YM, guys. Look at that wick up on the decision. Made a new all-time high. Back into the range. Wow.
Yeah, ES is getting hit too, down 35 basis points.
Yeah, ES is new lows of the day.
Yeah, it's down about 0.5%.
It's the low that it made. 66.21.
Yeah, 66.21.50. Volume is in the building.
Broke Monday low. We're looking at last Wednesday's high zone. It's getting retested now. Last Wednesday's high.
Yeah, double check that.
Yeah, it's looking like
last Wednesday high, 66.22.
66, 20 area. Check out the roadmap. Got my roadmap on my other computer here, the trading view joint. So Didn't trade today, so my charts are pretty bare right now. But the main thing is price is trading outside of previous day range to the downside on ES and Q, and was trading breakout to the upside on the YM, but now it's back in the range. How's wrapping? We're pulling back, guys. We're here.
Jobs. The overall job finding rate is very, very low. However, the layoff rate is also very low. So you've got a low firing, low hiring environment, and the concern is that if you start to see layoffs, the people who are laid off there won't be a lot of hiring going on. So that could very quickly flow into higher unemployment. In a healthier economy, healthier labor market, there would be jobs for those people. But now the hiring rate is very, very low. So that's been a growing concern over the last few months. And it's one of the reasons why we think it's appropriate that we begin to shift our policy focus toward a more balanced one.
Steve Leisman, CNBC. Mr. Chair, in the past, during rate cuts, you used the word recalibration. And I wonder if you pointedly did not use it this time. And in fact, when you said policy is not on a preset course, did you mean that as sort of the opposite of recalibration? Are we meeting to meeting, data point by data point? Are we in the process here of getting back to neutral? Thank you.
So I think we're in a meeting by meeting situation. We're going to be looking at the data. Let me say a word about the SEP really here. So we often point this out. What the SEP is it's an accumulation of the individual projections of 19 people, showing what they believe at a particular moment in time to be the most likely path for the economy and thus the appropriate path for monetary policy as well. And as you know, we don't debate or try to agree on what that is. We just write them down and accumulate them. We do sometimes discuss them. And so we always say we're not on a preset path, and we really mean that. The actual decisions we make are going to be based on the incoming data, the evolving outlook, and the balance of risks.
I'm going to explain all of this, by the way. I know what's happening, and it will all make sense in a moment.
10 participants out of 19 who wrote down 2 or more cuts for the remainder of the year, and 9 who wrote down fewer than, in fact, in a good number of cases, no more cuts. So rather than looking at this as certainty, I would encourage people, as always, to look at the SEP as through the lens of probability, and so there are different possible outcomes and likelihoods rather than this one is certain and this one isn't happening. So that's what I would say.
Thank you for getting to my follow-up question, which was: is the dispersion in the outlook a sign of uncertainty of policy in the meetings to come? Thank you.
You know, it is such an unusual situation. Ordinarily, when the labor market is weak, inflation is low, and when the labor market is really strong, that's when you got to be careful about inflation. So we have a situation where we have two-sided risk, and that means there's no risk-free path. And so it's quite a difficult situation for policymakers, and it's not at all surprising to me that you have a range of views. It's not so much about having different views for the path of the economy, but it's partly that, but it's also partly about what's the right thing to do in light of the tension between the two goals. How do you weight them? How worried are you about one versus the other? And so it's natural. I think it would actually be surprising if you didn't have a pretty wide range of views based, in this kind of highly unusual situation, and we do. So, but we get together, we discuss, we have a great discussion, and then we decide what to do and we act. But you're right that it's a wide dispersion of views, and I think that's understandable and natural in the current situation.
Hi, Victoria Guida with Politico. You've talked a lot about Fed independence and the importance of it over the years, but as markets have questions about what exactly President Trump...
Just a quick spoiler while she talks about Fed independence. What's happening is markets are nervous that the Fed is indeed going to be too late. He talks about, hey, we're going to get back to 2% inflation. He said a key phrase that turned the market. Job growth is now below break-even rate. That freaked everybody out. Why are yields going up? Because 25 was priced in for days. And he's being neutral. He's not going really dovish here. That's the problem. Neutral means rates up.
By the speeches that people give, by the decisions that we make, you'll know that
Yeah, this is back on Fed independence. Mind you, and I put this on the Meet Kevin app, so you can see it in the Meet Kevin app. But mind you, I wrote this to course members. Base Powell. We don't think 25 BP move does anything to bonds. Expect flat and slightly up on yields, as I think Powell will talk up the balance of risk, data dependent, meeting by meeting. And we will slowly unprice 6 cuts by March. This is the base case 65% neutral scenario that I gave to course members this morning. And I actually wrote, my take is we're going to see yields up after Powell today because he's not bearish enough. People think he's going to be too late.
Work exactly as we always have now. And people are...
You can literally see that. That's literally in the Alpha report. And I do those every single day to give you a heads up of what to look for in the day. MeetKevin.com.
See the court case around Lisa Cook as being related to questions of Fed independence?
You know, I see it as a court case that it would be inappropriate for me to comment on.
He's going to be too late, man. Stop asking about Lisa
thanks,
Cook.
Mr. Chairman. Edward Lawrence from Fox Business. So
Stupid.
We saw the preliminary benchmark revisions down 911,000. The revisions for June were the first negative revisions we've seen since December of 2020. You know, how can the Fed base important decisions on rate and what to do with the interest rates on data that seems to be, as you've called it in the past, noisy?
So on the QCEW, the revision that we saw was almost exactly what we expected. It was amazing how close the expectation was. So, and the reason for that is, for the last bunch of quarters, there's been almost a predictable overcount, and I think the Bureau of Labor Statistics really does understand this, and they're working hard to fix it. It's got to do, of course. It has something to do with low response rates, but it's also got to do with what's called the birth-death model, because a good amount of job creation happens around new companies and how many go out of business, how many are founded, and it's just really hard. You can't survey for that. You've got to have a model that predicts that, and it's quite difficult to do, especially when the economy is undergoing big changes. So, and they've been working on that and are making progress on it. But the data we get is still well good enough for us to do our work. To the extent we have issues around data right now, it's about low response rates. That's happened all over really. Response rates are just lower to surveys now, both in and out of the government. And it's no great secret. You know, we want higher response rates, and we need those to have, less volatile data. And the way to get that is to make sure that the agencies that collect the data have sufficient resources to drive higher response rates. It's not a complicated problem, but that's what it takes. It's not a mystery. That's what it takes. The other thing I'll say, Edward, is in the case of the job creation, the response rate is quite low for the first month, or lower for the first month. By the time you get to the second or third month, you're still collecting responses for that last month, for that prior month, and you get to the place where the data are much more reliable by the second and certainly the third month. So it's not that we don't get the data, it's just that we get it a little later.
But for the benchmarks, if that holds, it's 51% of the jobs that we thought were there weren't really there. Shows a weaker job market coming into this year. If you had had that information, would it have changed your mind related to where the interest rates should be? Should there have been a cut earlier?
You know, we have to live life looking through the windshield rather than the rearview mirror, as you know. Also and all I can tell you is we see where we are now, and we take appropriate action, and we took that appropriate action today.
That's fair.
Thanks. Howard Schneider with Reuters. So, as you mentioned a minute ago, some margins of the job market would suggest that the slide's already happening. Black unemployment rate in August was above 7%. Declining work week, difficulty among college graduates finding work, rising youth unemployment. Why do you think a quarter percentage point now is going to arrest that?
Well, I didn't say that I thought a quarter point would make a huge difference to the economy, but you've got to look at the whole path of rates, right? And the market's has already been baking in
25
expectations.
Matter.
I mean, our market works through expectations, right? So I think our policy path really does matter, and I think it's important that we use our tools to support the labor market when we do see signs like that. I did mention that. You know, you see minorities, unemployment going up. You see younger people who are more vulnerable economically.
Black unemployment is a red flag leading indicator.
That's one of the reasons, in addition to just overall lower payroll job creation, that shows you that at the margin, the labor market is weakening. I would also point to labor force participation. Some part of the significant decline in labor force participation over the last year has probably been cyclical in nature rather than just the usual aging process. So we put all those together, and we see that the labor market is softening, and we don't need it to soften anymore, don't want it to. So we use our tools, and it starts with a 25 basis point rate cut. But the market's also pricing in a rate path. I'm not blessing what the market's doing at all. I'm just saying it's not just one action.
As a follow-up to that, the growth mix right now seems very concentrated in investment and on the consumer spending side in the higher income groups. Do you feel that that's an unsustainable mix for the economy moving forward?
I wouldn't say that. I mean, you're right. Those are two. We're getting unusually large amounts of economic activity through the AI build out and corporate investment. I don't know how long that will go on. No one does. In terms of spending, you saw that the consumer spending numbers were well above expectations, and that may well be skewed toward higher earning consumers. There's a lot of anecdotal evidence to suggest that.
Yes.
Nonetheless,
the
it's
rich are spending.
So, I mean, I think the economy is moving along. Economic growth is going to be 1.5% or better this year, maybe a little better. Forecasts have been coming up, as you can see. So, labor market unemployment is low, but downside risks, but it's still a low unemployment rate. So, that's how we see it.
It's a mistake, man.
Hi, Stephanie Rule, MSNBC. Treasury Secretary Scott Bessent has said that the Federal Reserve suffers from mission creep and institutional bloat. He's now calling for an independent review. Would you support an independent review, or are you open to any sort of reform in any areas of the Fed?
I, of course, am not going to comment on anything the Secretary says or really any other officer says. So in terms of reform at the Fed, we just went through a lengthy and I think very successful process of updating our monetary policy framework. I would say there's a lot of work going on behind the scenes around the assets we have in the Federal Reserve Federal Reserve System and at the board. Are they the right size? We're actually going through a 10% headcount reduction through the whole Fed, including the board and all the reserve banks. The employment at the Fed at the end of that will be basically at the same level it was more than 10 years ago. So we will have had zero job growth for more than a decade when we're finished with that, and I think we'll probably do more than that. So I think we're certainly open to constructive criticism and ways to do our jobs better.
But not an independent review?
We're certainly open to always trying to do better.
Neil.
Mr. Chairman, Neil Irwin with Axios. There's been some debate lately on whether AI is already starting to affect the labor market in terms of lower labor demand, higher productivity by contrast. Do you buy that? And if that is true, does that have implications for the monetary policy setting?
So there's great uncertainty around that. I think my view, which is also a bit of a guess, but widely shared, I think, is that you are seeing some effects, but it's not the main thing driving it. And so particular focus on young people coming out of college, and yeah, there may be something there. It may be that companies or other institutions that have been hiring younger people right out of college are able to use AI more than they had in the past. That may be part of the story. It's also part of the story, though, that job creation more broadly has slowed down. The economy has slowed down, and so it's probably a number of things. But yeah, it's probably a factor. Hard to say how big it is.
Thanks, Mr. Chairman. What evidence do you see of tariffs showing up in inflation?
Well, if you can take goods, just sort of the broad goods category. And last year, goods inflation was negative. If you go back 25 years, that was the typical thing, was that goods inflation was, goods prices generally went down, even adjusting for quality. So that was not the case during the pandemic, of course. Goods inflation went very high, but we had essentially returned to zero or slightly negative inflation. Now, I think goods inflation over the course of the past year is 1.2%, which doesn't sound like a lot, but it's a big change. So we think, I mean, analysts have different views, but we think it's contributing, 0.3 or 0.4, something like that, to the current core PCE inflation reading, which is 2.9%. So it's contributing. What seems to be happening is that, the tariffs are mostly not being paid by exporters, mostly being paid by really the companies that sit between the exporter and the consumer. So if you buy something and you sell it through retail, or you use it to make a product, you're probably taking a lot of those costs on and not able to pass it fully along to the consumer yet. That appears to be what we're seeing. All of those companies and entities in the middle, they'll tell you that they have every intention of passing that through in time, but they're not doing that now. To the consumer, the pass-through has been pretty small. It's been slower and smaller than we thought. But the evidence is, it's very clear that there's some pass-through.
I also wanted to ask if you could share with us the conditions under which you might consider leaving the Fed in May.
I have nothing new on that for you today.
Hi, Katerina Saraiva with Bloomberg News. I just wanted to follow up on one of your answers just a couple minutes ago. We've often heard you talk about how you and your colleagues, do not think about politics. This
NASDAQ with the recovery, man. Peep this. Right back where it was. It crossed back over this structure right here. Tuesday low. And we could be back at this high like nobody's business. Yep, so that's why these are good observation days. Look at these candles. It's the 15-minute time frame. YM last 15-minute candle mud was the whole entire range of yesterday. Very nice. Very nice action. ES, you can see, right back up to the Tuesday low. About to cross it right now. Looking good, man. Looking good. The pullback is getting eaten up, though. Literally. A few more breaths, then NQ and ES is going to be back at all-time high zone. We're kind of looking at the same situation we've been in. So.
That's a crazy fucking recovery.
It's a V-shaped recovery like nobody's business.
Okay, if you look at the 5 minutes on the NQ, you can really see how fast they are.
Yeah, stocks did it the same way. You're talking about, shoot.
AMD's back.
Yeah, AMD is back. It's only down $1.88 now. Down 1%. It's trading 56, back at 59.
Pretty much. NASDAQ tips over 24,000.
ES is already doing it.
ES already doing it.
ES already back over Tuesday low. YM back over Tuesday high. Yeah, we're breaking structure across the board here. If you were into the buys, this would be that patient buy. You'd just be waiting for it to cross back over. I don't trade FOMC at all. Just off of past history, it's just inconsistent. You look at these candles right here. This is what you usually get on a FOMC day, what we like to call a good old air horn pattern. Look at that.
Seriously.
Look at that high right there.
Like, if you look at the 4 air horn,
Like,
I mean, as it is right now, but what's that spot?
that structure right there, as you can see, it makes a clean pathway to Tuesday high. But in that pattern, no stop is safe. Like, price started right here before the Powell news, like 12:45, 1 o'clock. Started to build up a little bit. By literally 1:45, we're up here. If you shorted the previous day low, you got stung. If you long this structure right here, you got stung. Nobody wanted this. This is diabolical work. So that's why we don't trade on these days. My account's already locked up. I've been relaxing all day, cooling. So that's why I love Fed days now. These used to be a big head scratcher, but you win some, you lose some. Overall, probably flat. But yeah, let's let Powell finish up. We're here, guys. We'll let Powell finish up. Kevin break it down. I'll give my consensus. Trump is not talking. He's in the UK. It's like 8 o'clock there. We thought Trump was talking at 3. They changed that news. He makes his own schedule, so what have you. And yeah, that's it, man. That is it. All right, cool. Back to Powell.
I said there was downside risk then, but I think that downside risk is now a reality, and there's clearly more downside risk. So I think that's broadly accepted. And so that meant different things for different people. Some wrote down, almost everyone wrote down, supported this cut. And some supported more cuts and some didn't, as you will see from the dot plot. So that's just the way it is. I mean, people have, you have people who take this work very seriously, think about it all the time, do their work, discuss it with our colleagues. We endlessly discuss this between ourselves, and then we have a meeting where we put it all out on the table, and this is what you get. And you're right, there's a range of views in the dots, and I think that's, like I said, very unsurprising given the quite unusual, historically unusual nature of the challenges that we face. But let's remember, though, the unemployment rate's 4.3%. The economy's growing at 1.5%. So it's not a bad economy or anything like that. We've seen much more challenges.
Market's going green right after we bought the dip. Let's go.
We're trying to accomplish. It's challenging to know what to do. There are, as I mentioned earlier, there are no risk-free paths now. It's not incredibly obvious what to do. So we have to keep our eye on inflation. At the same time, we cannot ignore and must keep our eye on maximum employment, which is those are our two equal goals. And you will see that there are a range of views on what to do. Nonetheless, we came together today at the meeting and acted with a high degree of unity.
Archie.
Thank you, Archie Hall from The Economist. You mentioned earlier that job creation was running below your guess at its break-even rate. I'd be curious to hear a bit more about that and where you think the break-even rate is.
So there are many different ways to calculate it, and none of them is perfect. But it's clearly come way down. You could say it's somewhere between 0 and 50,000, and you'd be right or wrong. I mean, there's just many different ways to do it. So wherever it was, 150,000, 200,000 a few months ago, it's come down quite significantly, and that's because a very lower amount of people are joining the labor force. The labor force really not growing much at this point, and that's a lot of where the supply of labor was coming from over the last 2 or 3 years. So we're not getting that now. We've got much lower demand. It's interesting that supply and demand have really come down together so far, except now we do have unemployment ticking up just one tick outside of the range where it's been for a year. 4.3% is still a low level, but I think this speedy decline in both supply and demand has certainly gotten everyone's attention.
Follow up, if I may. You mentioned the downside risk to employment a fair amount, but it's striking that measures of kind of activity and output for the third quarter, those that we have, seem pretty strong. The Atlanta Fed's GDP now is very strong. You mentioned strong PCE numbers as well. How do you square those things? Is there a chance actually could be upside risk to the labor market if those activity measures are right?
Well, that would be great. We'd love that to happen. So I don't know that you see a big tension there, but it's gratifying to see that economic activity is holding in, and it's a good bit from consumption. It looks like consumption was stronger than expected, what we got earlier this week, I guess. And also we're getting, a fairly narrow sector is producing a lot of economic activity, which is the AI build out and business investment. So we watch all of it, and I would say we did move up. The median for growth for this year actually moved up in the SEP between the June and September SEPs. So, and really the inflation and labor market didn't change much. It's really the risks that we're seeing to the labor market that were the focus of today's decision.
Nicole. Hi, Nicole Goodkind with Barron's. Thank you for taking my question. Given the cumulative impact of high interest rates on the housing sector, I'm wondering how concerned you are that current rate levels are exacerbating housing affordability issues and potentially hindering household formation and wealth accumulation for a segment of the population?
You know, housing is an interest-sensitive activity, so it's at the very center of monetary policy. When the pandemic hit and we cut rates to zero, the housing companies were incredibly grateful, and it was really, they said that was the only thing that kept them going, was that we cut so aggressively and provided credit and things like that, and they were able to finance because we did that. The other side of that is when inflation gets high and we raise rates, and you're right, it does burden the housing industry, and so rates have come down a bit, and as that happens, we don't set mortgage rates, but our policy rate changes do tend to affect mortgage rates, and that has been happening, and that'll of course raise demand. Lower borrowing rates for builders will help, builders will help supply. And so some of that should happen. I think most analysts think that it would have to be pretty big changes for it to matter a lot, big changes in rates to matter a lot for the housing sector.
Correct.
And the other thing is by achieving maximum employment and price stability, that's a strong economy. That's a good economy for housing. And then the last thing I'll say is, there's a deeper problem here. There's not a cyclical problem that the Fed can address, and that just is a pretty much nationwide housing shortage.
Yeah.
Or a lot of places in the country just don't have enough housing for people, and all of the areas around metropolitan areas like Washington, for example, are very built up, and so you're having to build farther and farther out, and that
correct.
So that's where it is.
And just a quick follow-up. During the last SEP, or the press conference following the last SEP, you seemed to indicate that policymakers lacked conviction about their projections, and I'm wondering if you still feel that way.
Forecasting is very difficult even in placid times, and as I've mentioned before, forecasters are a humble lot with much to be humble about. So I think right now is a particularly challenging time, even more uncertain than usual. And so I don't know any forecaster anywhere, really. Ask any of the forecasters whether they have great confidence in their forecast right now. I think they'll honestly say no.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. If you're cutting rates, why continue to reduce the size of your balance sheet, then pause the unwinding?
Well, I think we're cutting the size of our balance sheet quite marginally now. As you know, with the balance sheet, we're still in an abundant reserves condition, and we've said that we would stop somewhat above somewhat above an ample reserves level. That's where we are, and we're getting closer to that. We're monitoring it very carefully. We don't think that has at all significant macroeconomic effects. These are pretty small numbers moving around inside a giant economy. The level of runoff is not very large, so I wouldn't attribute macroeconomic consequences to that at this point.
And at his recent confirmation hearing, Stephen Myron brought up that the Fed actually has 3 mandates from Congress, not just jobs and stable prices, but also moderate long-term interest rates. So what does Congress mean by moderate long-term interest rates? How should we understand that when we see the 10-year Treasury moving? And how do you think about this part of the mandate when policy choices like rate cuts or balance sheet reductions affect the long end of the yield curve?
So, we always think of it as the dual mandate, maximum employment and price stability.
We're about to do our...
NASDAQ's pushing up against yesterday's low again. Tech is recovering. Tesla is the first Mag 7 stock to go green. Dow Jones back over yesterday high. Tesla's green at 0.5%. What a dip. What a dip by on Tesla. How low did it get? Ain't even really do nothing. Goodness gracious. Alright. Powell's still rapping. We're here.
And as something in a different way.
Thanks, Chair Powell. Matt Egan from CNN.
We recently learned that average FICO credit scores are down this year by 2 points, the most since 2009 during the Great Recession, and delinquencies are high for car loans, personal loans, credit cards. How concerned, if at all, are you about the health of consumer finances, and do you expect today's cut will help?
Not going to help.
So, we're aware of that. I think default rates have been kind of ticking up, and we do watch that. They're not at a level, I don't believe they're at a level where overall they're terribly concerning, but it is something that we watch. Lower rates should support economic activity. I don't know that one rate cut will have, a visible effect on that.
Exactly.
But over time, a strong economy with a strong labor market is what we're aiming for, and stable prices. So that should help.
Just to follow up, this rate cut is coming at a time when the stock market is at or near all-time highs, and some valuation metrics are elevated historically. Is there a risk that cutting rates could overheat financial markets, potentially fueling a bubble?
Nope.
We're tightly focused on our goals, right? And our goals are maximum employment and price stability. And so we take the actions that we take with an eye on those goals. Separately, and that's why we did what we did today. Separately, we monitor financial stability very, very carefully. And, I would say it's a mixed picture, but households are in good shape, banks are in good shape. Overall, households are still in good shape in the aggregate. And I know that people at the lower end of the income spectrum are under pressure, obviously. But from a financial stability perspective, we monitor that picture. We don't have a view that there's a right or wrong level of asset prices for any particular financial asset, but we monitor the whole picture, really looking for structural vulnerabilities, and I would say those are not elevated right now.
Jean, we'll go to you for the last question.
Last question, baby. Here we go.
Hi, Chair Powell. Jean Young with M&I Market News. I wanted to ask about inflation expectations. You've said the Fed can't take the stability of inflation expectations for granted. You mentioned at the short run they've gone up a little bit. I wonder if you can talk a bit about that. And then also at the long run, wondering, do you see evidence that the debate over Fed independence and the growing deficit is putting pressure on inflation expectations?
So, as you said, shorter-term inflation expectations have tended to respond to near-term inflation. So, if inflation goes up, inflation expectations will predict that it takes just a little while to get back down. Fortunately, throughout this period, longer-term inflation expectations both break even in the markets, and almost all of the longer-term surveys, Michigan being a bit of an outlier lately, have been just rock solid in terms of running at levels that are consistent with 2% inflation over time. So we don't take that for granted. We actually assume that our actions have a real effect on that, and that we need to continually show and also discuss our commitment to 2% inflation. And so you'll hear us doing that. But we're, as I mentioned, it's a difficult situation because we have risks that are both affecting the labor market and inflation. Those are our two goals, and so we have to balance those two. When they're both at risk, we have to balance them, and that's really what we're trying to do.
I'll get your answer, Jeffrey.
Your latter part of your question was about independence. I don't see market participants.
Close the laptop.
I don't see that that's something they're factoring in right now in terms of setting interest rates.
Goodbye.
Thanks very much.
Here we go. Holy smokes.
All right, Powell's wrapped up. About to get Kevin breakdown. I'll let you guys know my consensus. Market right here. NASDAQ pretty much recovered that entire downside candle. We're here, guys.
Want to talk about the very first thing is I want you to see the prediction that I made in writing this morning. I said base case, 65% chance Powell is neutral. I said we don't think that the 25 VP move does. Audio issue. What happened? Did the audio go to crap? Okay, is this better? I'll fix the audio there. Audio fine. Okay, all right. The audio should be better now. There we go. Sorry, better. All right. Anyway, fine. Sorry. All right, we'll restart that. Okay. Hold on. Take another sip here now. Damn it, y'all screwed me up. It's fine. I appreciate it. Actually, thank you for warning me, All right. The Federal Reserve gave us one hell of a meeting today, and there is so much to parse out of this. Are we going into a recession or not? How bad is what's actually happening? And what's Powell doing about it? Is he going to be too late? I'm going to tell you everything in this video. Spoiler alert, he's going to be too late, and it's created a little bit of a problem in markets. Let's talk about this. Quick note, I want to show you from the Alpha report this morning. Mind you, I also sent out a buy alert during the dip of the Fed meeting. Everybody who's a course member of the Meet Kevin Alpha report got an alert through our app. It's really great. But look at what we wrote this morning. This is a sneak peek into how I do with my Alpha reports. So it's not like some fancy document. I'm typing it with y'all, right? But it's real. It's my opinion. And so this morning, this is exactly what we said. This is what we predicted. Powell, 65% chance he comes in at neutral. I said, we don't really think a 25 move does anything to bonds. Expect flat and slightly up on yields as Powell talks about the balance of risks, data dependent, and being meeting by meeting. Mind you, he did all of that. We will also unprice this 6 cuts by March idea, especially on the back of retail sales, Atlanta Fed GDP. And my take, we're going to see yields up after Powell today, maybe to 4.15 on the 10-year. That could hit real estate stocks a little bit and give us a bit of a dip by today. That's something that we wrote this morning, and boy, here's what we got from the Federal Reserve. So I'm going to give you what happened, all right? So if you want that, you just go to meetkevin.com. It's MeetKevin membership. So here's what happened. We got a 25 basis point cut. We only had one dissent. We were expecting Bowman and Waller to join in dissents. Nope. Everybody ostracized Moran, but I have to give Moran credit. He didn't go dirty on the summary of economic projections. He could have gone dirty on the summary of economic projections and really tried to sandbag the SEP, but he didn't. He didn't screw up the ranges of the SEP. He stayed broadly in line with everybody, and this Fed is unified that unemployment is going to stay in the mid-4s. Now, they gave us a forecast that we are going to get 3 rate cuts this year, with 25 basis points of cuts next year and 25 points thereafter. This means yields are going up a little bit because markets have to unprice this idea that, oh, maybe we'll get a 50 or maybe we'll get 6 cuts by March. Some banks are calling for 6 cuts by March. Crazy. But anyway, I want you to see this. We only had a 2.25%, we only had 2.25 cuts priced in. So initially, when we saw 3 cuts getting priced, bringing that rate down to 3.6 at the end of the year, that brings us down from 4, then to 3.75, then to 3.5, which is a range of 3.5 to 3.75. That's why it says 3.6. It's technically like 3.65. But anyway, that's why we initially had this, oh my gosh, this is a dovish summary of economic projections. We thought, okay, we've got a little bit of a revision up in growth. We were expecting a revision up in growth. They went to 1.6. I was thinking 1.7. I thought they would have shown more of a revision up in the unemployment rate. They don't actually think the unemployment rate's going to move up that much. The Fed is very unified here. You don't have many crazy outliers. And even though you've got Moran in here, the dots show a lot of unity with, I mean, that's probably Moran over here. But again, everybody's just going to look at him as the Trumpian shill, and it doesn't really matter. What matters more than all of this, mind you, is what Powell said. Because initially, this sounded dovish, right? We get this summary of economic projections, and markets are like, oh, this is great. We're going to get more rate cuts. But wait a minute. Then Powell gave us a dose of reality. Then Powell told us, wait, guys, we've got serious problems, and the labor market is getting worse than we thought. Now, I'm going to explain all of that. But I want you to know that his reaction to the labor market is getting worse was, but we're going to stick with 25 basis point cuts and we're just not really going to do anything about it. That does create a little bit of nervousness, but it puts you in that neutral direction. That's why I said neutral Powell, which to me is bullish for our indices, and we're probably going to get to 600 on the Qs by the end of the month. That's also one of our alpha report price targets for the end of the month. I shouldn't give away all the alpha, but that's our take. It aligns with the neutral point of view in the report that we issued this morning. Now, What we have to know are the details of what Powell gave us. This is, in my opinion, the crazy part. To understand these details, you have to know there are two things that you could pay attention to know if what Powell is saying about labor actually gets a lot worse. And you could get this in the Meet Kevin app, by the way, if you want it. All this is listed out in the Meet Kevin app. You could change the colors. You don't have to use this green color. But anyway, I'm going to read it off right here. So, what changes the labor market? If labor force participation normalizes, because it's been shrinking lately, it's been falling, it's been little pee-pee, shrinkage, nobody wants that shrinkage. If labor force participation rises again, the unemployment rate will skyrocket to 5% very rapidly, and every single member of the Federal Reserve will be wrong, and they will have to cut substantially faster, and Jerome Powell will earn his name too late. Okay? Scenario number one, labor force participation increases. None of the Fed members are talking about it. None of them. That's a red flag. Okay? Then, if layoffs increase, this is the second, obviously the unemployment rate via the beverage curve will skyrocket to 5% and beyond very rapidly. Again, indicating that the Federal Reserve will be too late. So, we got 25. Is that enough to help the market? No. Not the stock market. Is that enough to help the jobs market? No, it's not going to make any lick of a difference to the jobs market. Now, why does that matter? It matters because of what Jerome Powell just said about the jobs market. I'm going to break that down. Now you know what the risks are. Now you know why, the yields market is moving the way it is. You also know why we bought the dip. We also know we bought the Fed dip, right? We also know why the stocks are moving up right now. But there's an underlying serious issue here, and Jerome Powell gave us multiple warnings. We're going to talk about that. I do want to quickly shout something out, and this is something that a lot of you have been asking about, and I'm so excited about this because you know how I spend like 30 grand a year to get those EPS forecasts for companies, and it's insane, like how much money this company charges? Y'all have been asking me, Kevin, is there like a consumer version of this? I've been looking for years for this, and this company came to me and they're like, Kevin, we have a product for you, and we'll do a sponsorship deal with you. So, this is the creme de la creme.
Boy, Kevin getting his ad off. Invest Pro, shout out Kevin. I am Screen Sniper, so shout out my boy Kevin. Let him get his ad off, man. He's just very good for the news for me. Been watching him since I started, so shout out Kevin. Alright, I got some keynotes here from the Fed. I'm going to let Kevin still continue to break it down once he's done with his ad, but pretty much labor market is getting worse, but they stuck with the 25 basis points. Not doing much equals a neutral Powell for today. Neutral is bearish for bullish for the markets. That's why we did pop up, but if the labor force does not normalize as the Fed expects and the unemployment rate skyrockets, then Powell will indeed be too late, which is a stereotype put on him by Trump, and he might end up living up to it. But yeah, 3 rate cuts this year. Yields went up because we had to pretty much unpriced 6 rate cuts by March. That's not going to happen. So 3 rate cuts this year. That's what we're looking at. And yeah, that's what we gathered so far, man. So pretty much Powell, he gave us a cut, but it's chill. It's not much. It's not anything that's going to affect the labor market, which is what's really suffering. If you're on the ground and you really know, black unemployment is getting affected. That's the first indicator. The job market is not good if you're on the ground. So Powell indeed might end up being too late. And that'll show in the data. Probably won't show until like early next year. But if that unemployment rate does skyrocket because the labor market is getting impacted right now, and that information is usually delayed, you know what I'm saying? So they pretty much already know it's going to happen. But yeah, man. Neutral Powell, bullish for the markets. We did recover. We're back over Tuesday low. Pretty much in the same spot that we've been trading in all day, besides the little dip outside the range. Anybody that stepped in front of that dip got paid a couple P's back to Tuesday low. But which is cool. But let my boy Kevin finish rapping. All right, guys.
Only getting a 25 basis point cut. That's why bond yields are up. Because we're only getting 25, which is the bond market telling you the Fed is going too slow. The bond market is screaming, Fed, you're making a mistake. That's what the bond market is telling you. I want you to understand those phrases are huge. He says, the downside risk to unemployment have risen. Disinflation continues in services, which is good on inflation. It appears we are under the break-even rate with hiring softening. Labor demand is less dynamic and softer. All bad. Tariffs are showing up, but the full effects remain to be seen, and we hope that they're going to be one-time and short-lived effects. Weird way he says that. The problem with that is he's basically telling you, hey guys, we're good on inflation. We're going to mostly have transitory inflation over time. Of course, he's not using that word, but we're going to mostly have transitory inflation over time. So he's not worried about inflation. Then he's telling you that we're under the break-even rate of employment at 29,000 jobs over the last 3 months. And then he's only giving us 25. He actually goes as far as saying that even though Moran voted for a 50 basis point cut, he says this is a risk management cut. There was not widespread support for a 50 basis point cut. Now, what's different, the reason we went for 25 and why we're going for 3 25s this year is because last meeting, we were at 150,000 jobs per month. Now we're at 29,000 jobs per month. This suggests the labor market is, quote, really cooling, and it's time to take that into account. Damn it, Powell! If it's time to take into account that the labor market is really cooling and that we're below the break-even rate of the labor market, then wake your ass up and give us bigger cuts. This ain't enough, and you're gonna end up being too late. That's why we're seeing those bond yields tick up a bit, which was part of our neutral expectation. I expected this morning when I wrote this in the Alpha report, I told course members, I'm like, look, he's just going to go meeting by meeting, data dependent, balance of risks. He said all 3 of those things. Why? Well, because why is he going to make a big forecast now? You know, Atlanta Fed GDP is at 3.6%. You've got retail spending, which is great, although he mentioned that you got to be careful with retail spending because it's really just the higher income consumers, right? They're the ones who keep spending. The rich get richer. Everybody else who's trying to work for a living is suffering. You got people like Elon Musk bragging about how hard he's working to earn his $1 trillion pay package. Oh, poor Elon Musk has to take a red eye at 11:30 at night from San Francisco or San Jose all the way to Austin, Texas, and it's a red eye. He makes it seem like he's sitting in a Spirit Airlines plane like this. You know, that's what he's making it seem like. I have my shorts on, so suck it. You get short shorts today. This is what, guys, I had to take a red eye. I'm working so hard for my $1 trillion. Bro, he's in the back of a Gulfstream jet, sipping on champagne and in a bed. He's got a bedroom in the back of his jet, and he's trying to make you feel like he's working hard. Bro, you should be doing this if you want $1 trillion. I don't know how I got into that rant, but the point is that there is real pain in this damn economy. And Jerome Powell is telling you, yeah, shit's kind of hitting the fan, boys and girls. We're below break even. Labor is weakening. You know, it's no longer a solid labor market. And there's meaningful downside risk. These are quotes. I wrote these down as quotes. There is meaningful downside risk, which is, quote, now a reality. Yet we only get 25. Again, we expected in the Alpha report this morning that we were only going to get 25. We expected that yields were going to go up. That's fine. That was my 65% base case. I did have a neutral scenario, which I called alternate number 1, but this didn't happen. You know, right here I said very concerned, like the dovish scenario would have been, you know, we're cutting more, we're going to, you know, maybe we're even doing some QE, we want to get back to a stimulus, Powell. That's what would be great for TLT. We want this, Powell, because it minimizes the risk of a jobs recession. We want this, but we did not get that. We also didn't expect we were going to get that, and we didn't think we were going to get a hike either. Again, 65% chance neutral, we got neutral. So you've got a Powell who's basically like, yeah, you know, we know the labor market's going to shit, but, you know, we expected that. He literally said those words. Hey, man, like these revisions, they're so large, these QCEWs. Yeah, you know, they were actually spot on our expectations. We expected that. I like Powell. Bigger cut then, damn it. Then he gets asked about black unemployment, minority unemployment, which, fact check here, black unemployment has shot up 1.5% to 7.5%. You know what Bloomberg calls that? They call that, quote unquote, that's rare outside of recessions. It is a leading indicator of a recession. This is why Powell needs to wake up. But, you know, he's like, oh, you know, but households are still in good shape. You know, we can always, basically what he's implying is, hey, like if things really hit the fan, we can always cut faster, but we don't need to do that right now. So yes, Powell is doing a really good job right now of earning his keep as being Mr. Too Late. This is not a surprise. We have the 10-year Treasury yield up modestly, 3.4 basis points to 4.06, broadly expected, okay? We have markets that are recovering, and I think we can get this slow schlager up because we don't really have negative catalysts until when? You should know this, October 1st and October 3rd. So, with all that said, thank you for watching the Fed summary video. Make sure you check out our sponsor, scan that QR code, or just go to meetkevin.com/pro and use coupon code MEETKEVIN to get those EPS projections and more. Try it out. Check out the Meet Kevin membership if you want.
Coupon linked below.
If you have any questions about house hacks,
Email.
Shout out my boy Kevin, man. Doing his thug dizzle. Alright, guys. That's going to be the FOMC, man. As you can see, markets didn't do too much of nothing. We got a nice wick down and wick back up into the Tuesday range, which is pretty much nestled up in those all-time highs. What me and my partner were just saying, that looks like the initial move, nothing burger. We haven't gotten a real move yet based off this data, but 3 rate cuts this year, pretty much the consensus. The bond market is going to rise, may continue to rise going into tomorrow. That might lead to a dip because we do have the unpriced 6 cuts by March. That's not happening. So we got a nice bullish, slightly dovish Powell today. Slightly dovish, but mostly like neutral bullish, like my boy Kevin said. Labor force is getting impacted. Kind of break evens right here. We're like below that break even point, so we're getting in negative territory on the labor market. So that's going to impact us, and you see what Powell decided to do, man. 25 basis cuts. So guys, trade smart, work smart, keep learning your skills, man. Keep investing, stay ahead of this, man, because you see what the mandate is for the Fed, man. You can tell what they're looking for, you know what I'm saying? So overall, good day. It's what we expected, 25 basis points. Market already had it priced in, pretty much in the same spot. Look down on the quote board. NASDAQ is flat, about 0.1 down. ES is flat, about 0.4 down, 0.3 down. And the YM is leading about 0.5% up. It's been up all day. So overall, good day, good work. About to relax, do some studying, get ready for tomorrow. It should be a great day. Contract roll is pretty much almost complete. Friday is a quad witching day, so that's the next kind of big catalyst we're looking at. But overall, most of the contract is in the December contract already. So if you know, you're already rolled, you're already trading it. Shout out Top Step X rolling for us already. Let me check the news terminal real quick. Shout out my partner. Check the news terminal. Check the headlines real quick, man. Couple currency stats here. Fed Powell, besides the outlier of the UN Michigan survey, longer term inflation expectations have been rock solid. Alright, cool. Nothing crazy coming through. Nothing red. You got any red headlines over there? Let's pull up on CNBC. This is what we're gonna be mostly watching tomorrow because it's gonna be showing these bonds.
Yeah, no red headlines. Just Google doing PayPal, not to do with short.
Bullshit.
Yeah, just know, just don't let the good time just keep going up. Tomorrow news every day, continue drivers.
Gotcha. Okay.
Like that's one of them. So kind of what Kevin was saying about the job market's going to keep something drivers fine. 25.
Yeah. All right, cool. So we got jobless claims coming out tomorrow. Continued jobless claims. This is probably going to add to the consensus that Powell, just said that the labor market is worsening. Looks like the forecast is 240 for the initial jobless claim. Continued claims 1.9 million, and it looks like both of these are lower than the previous. So the forecast is already expected to be lower than the previous month. So jobless claims, based on the forecast, might be lower than expected. Alright. Beautiful, beautiful. Anything else we need to tap in on? Wake up Japan rate decision middle of the night tomorrow. Those are gonna play. Yeah, that's what I was about to say. Those play a big play. What's the forecast?
It's a red dot too.
Is that the BOE?
It's a BOJ. Got 23 hour. Saturday.
Oh, okay. Tomorrow night. Oh yeah.
I don't know if the carriers are the big thing this year, but definitely across the market last year.
Right decision. Previous 0.5. Forecast for this 1.5.
They usually always do this the same way. It's like they're still.
Yeah, it's their stick. If they cut, then
change it from 0 to 0.5.
this is when it's like a big hoopla.
Yeah, I think they're very safe for the
Alright, cool, man. Yeah, it should be calm. Most of the volumes in the contract. We got jobless claims tomorrow. Nothing on Friday.
Nothing Friday.
No major news Friday.
Yeah, just
China talks. Oh yeah, we got the TikTok China talks. I think that's like the TikTok countdown. And it's Friday, I believe.
Yeah, that's 8 a.m. Friday.
Alright, cool, man. That looks like that's about it, man. 10-year Treasury yield rises at the wildly expected quarter-point cut by the Fed. So 10 years where we'll be watching. Once it's at about 4.06, if it gets to about 4.5 area, 4.4, that's when we're kind of looking sketched out. That's when the market's probably going to pull back, and the 10-year will be the reason. So yeah, man. Fed approves quarter point. Just going through the news, making sure we got everything. Moran was the only person that wanted that half-point cut. All that talk, it was only one Fed, and he's Trump meat bender. Shout out to President. Alright, man, let me get on up out of here, man. About to start my normal routine of prepping for the day. Do my homework. It's 3:50 right now. Day's over. Another successful day. It's one of my old-fashioned rules. Don't trade on the Fed day. It's like automatic, so that's always kind of cool to see. Kind of like the new breakout rules that we're working on. Feel uncomfortable when you're going through it, but eventually it'll be second nature, and you'll be actually treating these days like it's a day off. Start to enjoy them and stuff. So that's cool, man. Besides that, it's your boy Corey, man. Twin Peaks Trading. I'm up out of here, man. Shout out my partner, boss. Highly Production, man. Shout out everybody that tapped in. Make sure you like, subscribe, comment. Tap in with the Discord. Everything's free, man. Everything's wide open for you guys. Dropping a lot of good jewels on strategy, discipline, getting your daily checklist. Last couple of days, we haven't had any trades leading up to the Fed. You know what I'm saying? And that's all just following the process, letting it tell us when not to trade, when we're looking at a B setup. And we're literally like, my partner hasn't lost a trade all month, literally. And I only lost one trade this month. So Stats are good, so just follow the rules, man. When it's boring, what's the saying my dog Laney Trey say?
Boring stats, amazing payouts.
Boring stats, amazing payouts. That's what we're looking at, man. Boring stats, amazing payouts. So on the road to live funded, it continues. All of our accounts are pretty much at balance. You can see my leader at balance. This account at balance. We got another one of my partners in. He's pretty much at about 50,005. It has another account at like 50,000. So we got 4 combines going on the road to live funding with Top Step. Me personally and my partner individually as well. And yeah, man, thank God for the journey, man. I appreciate everybody tapping in. Make sure you like, subscribe, comment. I appreciate every viewer, every one of you guys, man. Every subscriber, appreciate you guys. We'll be back tomorrow, 9:30 a.m., man, ready to react to what just happened and make some money in these markets, man. You guys trade safe. We'll catch you next time. Bye.